Was macht den US-Hochzinsmarkt gerade jetzt so spannend? Der US-Hochzinsmarkt hat in diesem Jahr viele Investoren überrascht. Angetrieben durch niedriger bewertete Anleihen und eine überraschend geringe Ausfallrate erzielte der Markt deutlich höhere Renditen als erwartet. Doch während die Erträge vielversprechend sind, warten potenzielle Risiken am Horizont. Gerade in Zeiten wirtschaftlicher Ungewissheit gewinnen fundamentale Analysen an Bedeutung. Warum zeigen die Spreads auf dem US-Hochzinsmarkt keine deutlicheren Anzeichen für ein potenziell schwächeres Wirtschaftsumfeld? Welche Unternehmen können sich in dieser Phase behaupten? Historisch gesehen profitiert der Hochzinsmarkt oft von einem Umfeld mit niedrigem, aber positivem Wirtschaftswachstum. Doch wie sehen die konkreten Prognosen für das kommende Jahr aus? Welche Trends und Risiken sollten Investoren im Blick behalten? Antworten gibt es heute im Online-Seminar. Und damit wünsche ich Ihnen einen schönen Dienstagmorgen, liebe Zuschauerinnen und Zuschauer, sowie ein herzliches Willkommen zum ersten Teil der Finanzen-CH-Seminarreihe Swiss ETF Investor Days. Mein Name ist Jasmin Menzin und ich darf Sie als Ihre Moderatorin durch die heutige Veranstaltung begleiten. Ich freue mich sehr, dass Sie alle heute mit dabei sind und genauso sehr freue ich mich, unsere heutigen Gäste in dieser Runde nun begrüßen zu dürfen. Guten Morgen und herzlich willkommen, Adrian Steiner und Jack Stevenson. Schön, dass du heute bei uns bist, Adrian. Jack, it's so nice to have you here today.
Grüezi
Adrian,
miteinander.
Du bist seit 2023 bei AXA Investment Managers für Exchange Traded Funds in der Schweiz und Liechtenstein verantwortlich. Was sollten unsere Zuschauer sonst noch über dich wissen?
Ja, das ist eigentlich schon das Wichtigste, hast du bereits erwähnt. Wir sind relativ neu in diesem ETF-Bereich tätig und meine Aufgabe ist, wie du gesagt hast, der Vertrieb für Schweiz und Liechtenstein.
Vielen Dank, Adrian. Jack, you are an investment specialist in the core investment specialist and solutions team. Would you like to tell our audience something more about yourself before we start with the presentation?
Thanks, Jasmine, and good morning, everybody. Sorry for my lack of German here. Yeah, so I'm an investment specialist embedded within the US credit teams. The US credit teams are based out in Connecticut in the United States on the East Coast, but I'm based in London, which is a little bit unusual. The reason why I'm based in London is because my role as an investment specialist is really to form a bridge between what is happening in the investment teams and ultimately communicating that to clients. So I spend a lot of time on the road speaking to investors and presenting our different US high yield capabilities that we have.
Thank you, Jack. Bevor wir in deinen Vortrag einsteigen, Adrian, möchte ich Sie, liebe Zuschauer, noch auf Folgendes hinweisen. Bei Fragen oder Verständnisproblemen können Sie uns während des Webinars über die Chatfunktion kontaktieren. Einige Ihrer Fragen werde ich möglicherweise direkt aufgreifen und an unsere Experten weiterleiten. Am Ende der Veranstaltung wollen wir in einer Fragerunde gemeinsam noch offene Fragen klären. Außerdem haben Sie es vielleicht schon bei der Anmeldung gelesen oder eben gehört, unser Speaker Jack wird seinen Teil des Vortrags auf Englisch halten. Nun haben wir Sie, liebe Zuschauer, aber genug auf die Folter gespannt. Wir haben heute noch einiges auf dem Programm. Deswegen wollen wir direkt loslegen. Adrian, ich ernenne dich zum Moderator. Dann kannst du uns deinen Bildschirm übertragen. Die Rechte solltest du jetzt bekommen haben. Wunderbar, wir können deine Präsentation sehen.
Bestens, vielen Dank, Jasmin. Ja, gerne stelle ich Ihnen kurz AXA Investment Managers etwas genauer vor. Wir sind der Vermögensverwalter von der AXA-Gruppe, von der Versicherung. Wir haben ca. 850 Milliarden Euro, die wir verwalten. Ein Großteil davon stammt von der Gruppe selber, aber natürlich auch von externen Kunden. Da unsere Mutter eine Versicherungsgesellschaft ist, sind wir auch, wenn wir die Assetklassen anschauen, sehr stark auf Fixed Income ausgerichtet, also etwa die Hälfte von unseren Assets. Und eben dann auch US High Yield, das dazu gehört. Wir sind global aufgestellt. Wir haben ca. 2700 Angestellte. Wir haben auch einen größeren Standort hier in Zürich. Das ist natürlich geschuldet, damit dass die AXA vor ein paar Jahren die Winterthur-Versicherung übernommen hat. Wir haben ein sehr großes Team, das sich um Immobilien hier kümmert. Aber wir haben auch ein Team, das zum Beispiel sich um das Schweizer Obligationen verwaltet von hier aus. Und dann haben wir natürlich auch Vertrieb, wo ich dann zum Beispiel hingehöre. Wie bereits erwähnt, wir sind vor 2 Jahren im Bereich der ETFs gestartet. Für uns gab es eigentlich, sage ich mal so, 3 große Themen. Das eine ist sicherlich Fixed Income, also Obligationen. weil wir da einfach historisch gesehen auch sehr viel Expertise haben. Dann das zweite ist aktive ETFs, also aktiv verwaltete Strategien. Und das dritte ist Nachhaltigkeit. Vielleicht gerade kurz hier beim Überblick. Sie sehen es, Fixed Income, aktive Strategien. Zuoberst, das sind Euro-Credit, Dollar-Credit, aber auch US-High-Yield. Die Idee ist da wirklich, dass wir eine Strategie zu bauen, die von einer Vogelperspektive eigentlich den Benchmark repliziert, aber dass wir da dann unsere Expertise reinbringen und, sage ich jetzt mal, ein besseres Resultat wie der Benchmark erzielen können. Aber wir haben auch aktive Strategien im Bereich der Aktien, zum Beispiel, das sind eher thematische Exposure, zum Beispiel Biodiversität oder Klima. Aber wir haben auch ganz klassisch Index-Tracker hier im Bereich zum Beispiel MSCI World für Paris-Aligned Benchmarks. Aber kommen wir etwas zum Thema von heute, US High Yield. Das ist eine Expertise, die bei uns sehr stark ist, sehr groß ist. Wir haben da auch sehr viele Produkte zur Auswahl. Hier nur ein Ausschnitt davon. Sie sehen zum Beispiel auf der dunkelblauen Seite, das sind unsere aktiv verwalteten. Da haben wir zum Beispiel Produkte, die Short Duration sind, oder dann in der Mitte dort dynamisch, wo wir auch zusätzlich noch Credit Default Swap schreiben als zusätzliche Einnahmequelle, oder dann den breiten Markt abdecken. Und jetzt eben relativ neu, seit Ende vom letzten Jahr haben wir auch eine High-Yield-Strategie im ETF-Mantel. Aber um Ihnen da einen besseren Überblick zu geben, wie wir den Markt sehen und wie wir das im ETF replizieren, möchte ich gerne zu Jack weitergeben. Jack, I hand it over to you.
Great, thank you, Adrian, and that's a great segue, that slide, into the US high yield market. And I want to spend a little bit of time providing a bit of an update on what's been happening in US high yield and maybe in the US economy more broadly. And then I want to link that in to the US high yield ETF, which we're very excited to be managing, the first UCITS active US high yield ETF of its kind. So maybe just on the first slide here to step away a little bit and just think about where we are in the overall economic situation in the US at the moment. We obviously saw the first rate cut from the Federal Reserve a couple of weeks ago now, and the market has reacted quite well to that. You know, we've had this extraordinary period of the Fed and all central banks trying to raise interest rates to tackle inflation, and we can see on the left-hand side of this slide that inflation is now starting to moderate back towards the Fed's target of 2%. It's not there yet. We expect it to get back to 2% by about midway next year. But I think on the balance of risks, the Fed is now starting to look particularly at the labor market. And we saw at the start of August, there was a miss on the payrolls that came in below expectations in the US, and that created quite a lot of market volatility that maybe the Fed had missed the boat a little bit with regards to starting to ease policy, and maybe that was going to create some sort of recession in the US that many people were expecting to occur last year. That never occurred. What we've seen on the right-hand side is the market responding to that in quite a volatile way. So what we are showing here is what the market was pricing for the Fed funds rate at the end of 2023 in the green circle there, at different points over the last year or so. So we can see the bottom line there is the market anticipating in December that we were going to have 6 or 7 rate cuts. You know, it got very excited about the prospect for rate cuts, which was then priced out in the first part of this year. And again, there was that attention on the higher for longer environment. So we can see the orange line there, the huge move there up in rates once again as all of those rate cuts got priced out, and the market started to focus once more on how sticky core inflation was in the US, and maybe that would limit the ability of the Federal Reserve to cut rates at all. Where we sit today is that markets have responded in the dark blue line quite positively to the Fed's rate cut, and we expect, and the Fed itself has signaled, that we are going to get more rate cuts this year. You know, currently the market is expecting, at least another 50 basis points of cuts for this year, and the Fed has signaled a potential 100 basis points of cuts for next year. So we've seen a big rally in all fixed income markets, not just after the Fed cut rates, but in anticipation of that rate cut, which has meant that all fixed income markets, inclusive of high yield, since that April timeframe have really been driven by what has happened in the 10-year Treasury. And in the first part of the year, that was very different, where we saw rates moving higher, and that created a lot of dispersion in the high yield market as concerns started to emerge over high yield companies' ability to refinance with very high interest rates. Now, if you go to the next slide, Adrian, I think the US high yield market has surprised a lot of people over the last couple of years or so, who were expecting coming into 2023 to see that recession that never occurred, and possibly to see a pickup in the default rate and potential negative performance from the high yield asset class. What we are showing here on the slide is what has happened to the US high yield market return in the green line since the beginning of 2022, and on the right hand side since the beginning of 2023. And we can also see here what has happened to flows into high yield. So we can see active flows in the light blue line and passive ETF flows in the dark blue line. And really the story has been one of the high yield market going one way and flows going the other way, as many people were not expecting to see this kind of performance from the US high yield asset class. Now, the dark blue line, that's the ETF flows, you can see have started to go positive, and we've seen a pickup in flows year to date of plus $14 billion year to date into US high yield collectively, most of that driven from the ETF flow. But the active flows still have not yet caught up, because a lot of those active flows were going into higher quality asset classes like investment grade credit, like the government bonds, and definitely cash that people were expecting would outperform. Now, if we look at these tables at the bottom, we can see that versus the US high yield return over the 2022 timeframe, investment grade has underperformed by a lot, treasuries have underperformed, cash has done pretty well, as represented by the SOFR 3-month rate. On the right hand side, the US high yield asset class has delivered a 20% return since the beginning of 2023, which has outperformed all of these other asset classes, inclusive of cash. So I think a lot of people have been surprised and maybe caught out by the strong performance that we've seen in US high yield. Now, on the next slide, I think what we can start to see is the benefit of US high yield from an all-in yield perspective versus those other asset classes I mentioned, so treasuries, cash, and investment grade. And I think particularly as we look ahead, the Federal Reserve is now cutting interest rates, and that is going to mean that there's going to be some reinvestment risk in cash deposit rates, as every time you are rolling over your T-bills, maybe every 3 months or every 1 month, it's probably going to be at a lower rate now that we're going to see the Fed cutting rates than the previous one. So we know that there is a lot of cash that is built up in money market funds and is on the sidelines that is looking for a home. And what we can see here is that the Treasury market and the US investment grade market currently are offering negative yields versus that cash rate. Now, we don't expect that to continue for very long, but in contrast, look at the pickup that the US high yield asset class is offering with a yield to worst today that is still around 7%. You are getting more than around 200 basis points of pickup versus the prevailing cash rate, and we would expect that gap to widen. So we do think that the US high yield asset class is well positioned to benefit on a go forward basis from some of the investor capital that is going to be looking for a home. And why is that important? We see on the next slide what happens in US high yield when we have higher yields, which is quite a simple concept. But on the right hand side, we can see the starting yield to worst at the beginning of different calendar years and the annual returns that followed that. Now, it's very rare in US high yield to have negative returns. Here we see the red lines are the negative years we've had since the year 2000. But if we wind the index back to when it began in 1986, over 75% of the time, the US high yield market has delivered a positive calendar year return. It has also never delivered 2 negative consecutive years. That's because the coupons reset after a sell-off at higher levels, and income takes over once again as the main driver of returns. So if we look at what's been happening more recently, we saw this quite negative environment for all of fixed income in 2022, driven by higher interest rates. The US high yield asset class was not immune from that and was down minus 11.2%. But then we entered 2023 with much more yield at 9%, and therefore we shouldn't be surprised that we had this nice 13.5% return last year. We still have nice yield in the asset class. It has come down since the start of the year, but it is still around 7%, and the market today is delivered an 8% year-to-date return to the end of September. The reason why we still think that there is a lot of potential returns to come from the asset class is not only because we have nice income in the asset class, once again, thanks to the move in interest rates, but also on the left-hand side, what you see in the blue line, which is the average dollar price of the market. And we can see in 2022, we saw quite a significant decline in that dollar price as the market sold off, but actually we haven't yet seen the full recovery of the market from a dollar price perspective. So historically, the long-term returns of the high yield market are driven by income, but we do also have the potential for these very powerful rallies to occur after a sell-off. Now, we are still in the midst of that recovery from that sell-off in 2022, where the dollar price got down to the high 80s and has started to recover, particularly in December last year, and remains discounted at about 95 or 96 cents on the dollar on average for the market. So as the market continues to recover, we're going to see bond prices improve, and that's going to increase the return potential on top of the starting coupon income. So we do think that having yields back in the asset class is attractive for potential returns as we move forward. Now, on the next slide, we can see what that has looked like on a very long-term basis. So here we are showing the performance of the US high yield index, the ISB of a US high yield, since we started to manage US high yield strategies at AXA IM in September of 2001. And we can see over that very long time frame that the US high yield market has outperformed these other fixed income asset classes like the 10-year Treasury, like the US investment grade index, and also like leverage loans. So it shows that the power of that carry, compounding that income available to us, which is quite attractive in high yield, is going to lead over long time periods to outperformance versus these different asset classes. So on the next slide, if we just look at what the year-to-date picture looks like, and this is to the end of August, you can see that the high yield index was up 6.3%. We've had a strong month in September after the Fed cut interest rates, so we're about 8% today. But we continue to see, and this is surprising people as well, that the lower rated part of high yield, so the CCC component there, is outperforming the higher quality part of high yield, the double Bs. And that is surprising because so much of the return since April has been driven by what's been happening in the 10-year Treasury, yet we still have the lowest rated part of the market outperforming. And I think that is testament to the fundamentals of our market, which remain in very good shape. So the high yield market continues to perform well. And if we look on the next slide, we can see some of these fundamental metrics that we look at when we start to think about what is happening in default. So on the left-hand side, we are showing the average amount of leverage in the high yield market. And you can see that we're coming off all-time low levels of leverage really since the global financial crisis. And that is because high yield companies were very proactive in reducing leverage when interest rates were low, in pushing out maturities. And so as interest rates have gone up, we haven't seen high yield companies really adding to their leverage because they're very incentivized to keep the overall interest burden manageable and not too dissimilar from what it was when interest rates were low. So we haven't seen pickup in leverage, and you can see by ratings at the bottom that actually the double Bs are in very good shape. The triple Cs, where you do have slightly more leverage, that part of the market has actually been declining in leverage, whereas we've seen a slight pickup year over year in the double Bs and the single Bs. So the triple C part of the market has seen a lot of credit improvements. And we can see that on the right-hand side as well when we look at interest coverage ratios. This is the amount of cash flow that high yield companies have available to be able to service their interest expense. And once again, we can see we're coming off all-time high levels since the global financial crisis. And again, where we have seen improvements in interest coverage has been in the CCC part of the market. So we've really seen the whole high yield market improving in credit quality. 50% of the high yield market today is rated BB, just 12% in CCC. And that is testament to the fundamentals of our market, which remain very strong. And so when we come to think about the default rate on the next page, we can see on the top left-hand side the long-term default rate of the US high-yield bond market and leverage loans. And the long-term average default rate for high-yield bonds, this is JP Morgan data, is 3.3%. Now, we have been on the more conservative end for our own expectations because we conduct a very fundamental bottom-up driven approach every year where we look at where potential defaults could come from in our market. And coming into 2023, many, I think, macro sell-side strategists were forecasting a much higher default rate in the high-yield market. We were calling for a kind of 2 to 4% default rate and still are today, so very much in line with those long-term historical averages. But actually the default rate has surprised even our own conservative estimations and certainly surprised, I think, a lot of the sell-side strategists. We can see in 2021 that the high yield bond market had a 0.4% default rate, so very, very limited amount of defaults as we saw a lot of fiscal and monetary support put in place. Now that interest rates have gone up, our own view was that defaults would start to migrate back up to those levels in line with long-term historical averages. What we can actually see on the right-hand side in the table is that default rates remain below our own estimation. So at the end of August, we had a 1.7% default rate, which includes distressed exchanges. But if you exclude distressed exchanges, that's just a 1% default rate for the high yield bond market. Now, we are seeing slightly different trends in the leverage loan market. You can see the pickup in distressed exchange activity there. And so that we're seeing diverging trends between bonds and loans reflected in the fact that the high yield bond default rate is at a 20-month low compared to the leverage loan market, which is at a 3-year high on the default rate there. So I think, we'll come on to talk about spreads, but, when we think about spreads, we need to bear in mind the fact that defaults are very low, and that is really what spreads are there to compensate investors for. I think the other reason why spreads remain quite expensive today is on the next couple of pages, when we start to look at the primary market, and we've had a very strong technical market for high yield over the last few years. We can see on the right-hand chart that actually over the last couple of years, the high yield market has shrunk from its peak in 2021. That is because we've seen less new issuance coming through as rates have been going up, but demand has remained very strong. So if we look at those sources of supply and demand on the left-hand side, we can see on a calendar year basis, 2023 and 2022 there. Look at the amount of rising stars we also had going from high yield to investment grade. So the amount of debt leaving the high yield market being upgraded to investment grade, we had nearly $250 billion worth of debt moving up into investment grade. And from a supply perspective, that was not being replaced by fallen angels. We saw only $28 billion worth of debt being downgraded into high yield. We saw the largest rising star ever, which was Ford, the global automobile company. So we've seen, a lot of demand coming out of the high yield market, and not a lot of new supply coming in. We can see in terms of gross new issuance there, after really strong years in 2020 and 21, when rates were low, we saw much less volumes in 22 and 23 of around 107 billion and 175 billion. So the technical demand has remained very strong, and we see at the bottom here in the leverage loan market as well, that the CLO new issue pace has remained also very strong, which surprised us a little bit. We thought that some of these CLO structures would be expiring at the end of last year and they wouldn't be renewed. Actually, they were renewed, and demand for leverage loans, particularly from the CLOs, has remained very strong, and that's been supportive of all US leverage finance. On the next page, we can see a few more data points here. We can see on the left-hand side that new issue volume that I was referring to. But I think what's really interesting is when we start to think about maturities in the high yield market, very few high yield bonds actually reach their final maturity. Only 20% historically of high yield bonds tend to reach maturity. So what a lot of people have been worried about is that high yield companies, as rates are going up, would maybe not be able to refinance at these levels and would be waiting until the last minute. But what we've seen is that in 2023, out of that $176 billion worth of new issue, around 2/3, 66%, was used for refinancing activities. And in 2024, we've seen something like $250 billion worth now of new issue volume, and over 78% has been used for refinancing purposes. So high yield companies are still being proactive in coming to market and addressing their maturities early. And we can see in the chart at the bottom here that actually the high yield, the new issue market does remain open and accommodative to all of the market. And we're showing here the B3 rated and lower for bond and loan issuance is now at a 3-year high. So that is a really good sign in terms of having a healthy primary market. And that is meant that when we go to the next slide, Adrian, we can see that all of these factors come together, the technicals, the fundamentals, and the attractive macro fundamental backdrop to mean that today we have spreads that have just kept going tighter and tighter. Spreads, as I said, are not there to compensate investors for all the macro things that we like talking about, even though they can react to them. Spreads are there to compensate investors for default risk. And our view of the defaults is that they will remain quite benign at levels in line with long-term historical averages. Therefore, spreads shouldn't need to be so much wider. That said, they are expensive, but the offset or the mitigating factor to that is yields, which we can see in the blue line on the left-hand side remain at pretty attractive levels compared to recent history. So I think spreads almost I would describe as being justifiably expensive, but we can imagine over the next 12 months or so potential for spread widening, maybe on the US election, but things happening outside of the US high yield market that have the potential to see wider spreads. I think that might create buying opportunities for people that are waiting there on the sidelines to see wider spreads before coming back into the asset class. So I think that to some extent limits the ability of spreads to go so much wider. So I'm going to change now to just saying a few words on the active US high yield ETF that our team manages. And maybe just to step back and understand, first of all, the rationale for why we launched an active US high yield ETF, the first UCITS vehicle of its kind. I think passive high yield investors really face two main risks. The first is that on the left-hand side, we know in the equity markets that indices are constructed according to market capitalization, and that can do quite well, particularly when you have in the S&P 500, the top 7 stocks are driving all the performance. In fixed income, that is not the case. The index is not constructed according to market cap. It's constructed according to the amount of debt that companies have, right? And so that can lead to some potential traps where here we are showing the top 15 issuers in the high yield index today, and we can see whether it's based on spreads, yields, and ratings, that actually the top 15 issuers are not reflective of the underlying credit quality of those different issuers. So that could mean that actually by passively trying to replicate an index in high yield, you're going to be exposed or more exposed to issuers that have greater default risk just based on their weighting in the index, not looking at it through fundamentals. On the right-hand side, we know that, again, if you have the index yield, if you are trying to passively track the index, you might have, let's say, an 8% yield on the index there in the green. You might assume that you're going to get that 8% return, but we know that if you are exposed to too much loss and too much default, that that's going to erode your potential returns over time. So if we assume here a recovery of 25 cents on the dollar, so you're going to lose 75, and let's say that the index experiences a 4% default rate in the green at the top, with a yield of 8% and a default rate of 4%, you're going to have a 5% return, right? So you're not going to get that realized return of the 8%. Now, what we can do with an active lens, by applying our fundamental security selection and our active management, that's where the alpha opportunity comes. So if we can avoid those defaults entirely, that 0% in the green on the right-hand side, that's where we get the 8%, right? So it shows you where the alpha opportunity comes through active management if we're able to mitigate against losses and defaults in the high yield market. On the next slide, we can also see that for many passive ETFs, they are not actually even trying to track the broad US high yield market. And actually, you tend to find that because they prioritize liquidity above everything else, you might find that they track an index like the Market iBoxx Liquid High Yield Capped Index, where you are already reducing the universe to focus primarily on those top weighted issuers, where, as I said, a lot of those are not necessarily constructed according to fundamentals, and you're already giving up yield in terms of prioritizing that liquidity. So you can see the broad US high yield market at the end of August had a yield of 7.3, whereas the more constrained index had a yield of 6.9. So even before we talk about losses and defaults, the prioritization that the passive ETFs have on liquidity above everything else means that you might not actually be getting access to the full US high yield market. And you can see at the bottom of this table what that has meant from a return perspective if we just compare the broad US high yield index, which is our reference benchmark, versus the constrained index. And you can see the difference in returns there is quite material. So the starting point isn't necessarily the same when we think about passive and active ETFs. On the next slide, Adrian, we can see here that over the long term, we're comparing the high yield index that we manage against has outperformed some of these passive ETFs, and we're showing a couple here. And that shows you that active is really working. This is a good way to access the high yield market, particularly when the market is volatile. You tend to get a lot of people trading in and out of the passive ETFs, and that means that it's a lot harder for the passive ETFs to keep up with the market because they generate a lot of transaction costs in doing so. So we think that passive high yield ETFs are inherently quite flawed. And so on the next slide, what we are trying to bring to this market is the benefits of the passive ETF, so the transparency, the liquidity, the efficiency that investors find in trading these products, but with all the active benefits of our US high yield team, enlarging the opportunity set, having top-down views on the market in terms of how we want to position, but also protecting on the downside. So what that leads to is our ability to keep tracking error low, with regularly rebalancing. So every month we are rebalancing the portfolio, or intra-month if we need to. We're able to mitigate against those specific risks within the high yield market that I referred to, and we can navigate through different market environments to position from a duration and yield perspective versus the index, but also from a security selection perspective, really seeking those alpha opportunities. On the next slide, you'll see just an overview of AXA IM's US high yield platform. So we have $13.5 billion worth of US high yield active AUM. We don't manage any passive US high yield strategies. So we've been doing this for a very long time. We've been managing US high yield strategies through multiple credit strategy cycles since 2001. So we really have all the experience that we bring as well now to this active ETF. And really, we have a great status with all the major Wall Street brokers, which allows us, great access to primary market and also the ability to minimize transaction costs. I mean, maybe Adrian, just to fast forward a couple of slides here, just to look at the portfolio today. If you go forward a little bit. So this is the high yield ETF as we stand today, and we can see the benefits of this active portfolio. Is first of all our ability to choose how we want to be positioned versus the index. So you can see today the index has a duration of about 3. We've got a duration quite in line with the index, but slightly less yield. We don't see many opportunities out there in the higher yielding part of the high yield market today because of the amount of spread compression that we've seen. So you can see that in the bottom left hand side, if we look at the amount of the ETF that has a yield greater than 9+% on the right-hand side, we have a lot less than the market. So we're more defensively positioned today because spreads have tightened in quite a bit. But we do have, interestingly, an overweight to the CCC part of the market. You can see on the right-hand side, 13.7% versus the index 12.4%. And if you go to the next slide, Adrian, I'll show you that just because we have an overweight to CCCs, not all CCC risk is the same. And this, again, shows you the benefits of what we can do from an active perspective. On the left-hand side, if we look at our CCC exposure, we have a weight of 13.7%, but the average yield of our CCC exposure is 9.8% versus the index average CCC yield of 13.4%. And if we break that down from a dollar price perspective on the right-hand side, you can again see that we are owning the higher quality part of the CCCs and staying away from those low dollar price CCCs that potentially are going to have problems and may go on to default. So from an active perspective, we can really choose how we want to be positioned, both from a top-down perspective versus the index, but also from a bottom-up perspective in terms of the kind of credits that we like fundamentally. So maybe just to summarize, and then I'll hand it over. On the next slide, I really think that we're seeing a new frontier for high yield ETFs. As I said, we've brought to market an innovative solution here where we are harnessing the power of our active high yield expertise within the ETF wrapper, with all the benefits of lower tracking error, of transparency, of daily liquidity that people enjoy with passives. As I said, secondly, you're getting the benefits of active. What do we mean by that? The ability to avoid potential risks that are prevalent in the high yield market, particularly around avoiding defaults through time, but also being able to choose how we want to be positioned, both from a macro perspective and fundamentally. And I think, we do have a long-standing expertise and a very experienced team of senior portfolio managers that have been working together for 17 years in the US high yield team at AXA IM. And I think scale and experience really matters. The ability to manage different types of risks that are there in the high yield market really gives us a strong advantage. So let me pause there, and then I'll hand over for any questions.
Thank you so much, Jack. We've received a few questions from our audience that we should address in a brief Q&A session. I will read first the questions aloud in German and then translate them into English for you. Liebe Zuschauer, wir machen noch eine kurze Q&A-Runde. Ich werde zuerst die Fragen auf Deutsch vorlesen und sie dann für Jack auf Englisch übersetzen. Unsere erste Frage lautet: Was ist der Unterschied zwischen dem US High Yield ETF und einem normalen US High Yield Mutual Fund? So, Jack, the first question is, what is the difference between the US High Yield ETF and a normal US High Yield Mutual Fund?
Yeah, so we wanted the ETF to very much be an extension of the same philosophy and process that we have on the mutual fund, because we've shown that that has been quite successful over time in generating alpha and minimizing volatility. So we didn't want to change too much. However, clearly there is a difference in the implementation when it comes to the ETF wrapper. And we are also, trying to enable good liquidity on the ETF. It's worth saying that the mutual fund, the high yield market, is a very liquid market. But on the ETF, just because of the wrapper, we want to make sure that we are a bit more prioritizing maybe some of the more liquid part of the market than in some of our active mutual funds. So we might have a slightly higher position count. So on the mutual fund, maybe we have 250 bonds in the portfolio, whereas in the ETF, maybe we have 300, 350, something like that. And that allows us to reduce the tracking error versus the mutual fund as well, which I think ETF investors want as well. But crucially, there is no difference to the team, to the philosophy, to the overall process, just a few differences in terms of how we tweak the product to suit the ETF wrapper.
Thank you, Jack. Liebe Zuschauer, kommen wir zur zweiten Frage. Was sind die ESG-Ausschlüsse und welche Auswirkungen haben sie? So, Jack, the second question is, what are the ESG exclusions? What is the impact?
So from an impact perspective, very little. You know, we at XRAM, we have various different exclusion policies, from climate risk to controversial weapons to tobacco, and also, you know, we avoid low ESG scores. So you know, bonds that maybe have an ESG score that is CCC rated, which is the equivalent on a proprietary scale that we have of 1.43 and below. So we exclude the lowest rated ESG bonds in the market. If you put all of that together, you are looking at maybe 4 or 5% of the high yield market that is excluded from those exclusion policies. So you know, we are not giving up a lot of the universe for our exclusion policies. The ETF, it's an Article 8 product, so we are also committed to trying to beat the benchmark ESG score. We will have a higher ESG score in our ETF than the benchmark, the ISB of A US High Yield Index.
Thank you so much, Jack. Liebe Zuschauer, kommen wir zur letzten Frage des heutigen Webinars. Wie hoch ist der Tracking Error? Jack, let's talk about our last question of this webinar. What is the tracking error?
So we launched the ETF in December of 2023, so we don't even have a 1-year track record yet. If I look more broadly in terms of, you know, what we expect the tracking error to be, we would expect it to be lower than our mutual fund. Our mutual fund over the long term might have a tracking error of maybe 1% or maybe sometimes 1.5%. So in the mutual fund, we're not afraid of taking tracking error. I think that's important in high yield, that you are differentiating from an active perspective from the index. That tends to be where you generate alpha. You know, you tend to get into problems if you're hugging the benchmark too much. Right, and so I think, you know, taking tracking error is not, we don't view it as a bad thing. In the ETF, we expect to have a lower tracking error. So I mentioned that we'll have a slightly higher position count. So we might expect the tracking error of the ETF to be about 0.5%. So quite a bit lower probably than the mutual fund. But as I said, it's a bit too early to give actual track record data because we don't yet have a 1-year track record.
Thank you so much for those explanations, Jack. Liebe Zuschauerinnen und Zuschauer, unser Online-Seminar neigt sich nun dem Ende entgegen. Vielen Dank für deinen Vortrag, Adrian. And my thanks also go to you, Jack, for your presentation and for answering the questions during the Q&A session. Ich möchte Ihnen, liebe Zuschauer, noch den Hinweis geben, dass dieses Seminar aufgezeichnet wurde. Sie können es sich jederzeit also noch einmal anschauen. Ein Aufzeichnungsartikel wird ebenfalls heute Nachmittag auf der Startseite von Finanzen.ch erscheinen. Jack, I'd like to ask you for some closing words for our seminar today. What would you like to leave our participants with as final takeaway?
Yeah, I would say that a lot of people are focused on spreads in the high yield market that are expensive, but I would say that spreads are justifiably expensive given what I've said about the strong technicals and definitely about the fundamentals. And ultimately, I think spreads are reflecting a very benign default in the US rate in the US high yield market, which should mean that the default that spreads maybe shouldn't be so much wider like everybody thinks. At the same time, we have very attractive yields and we still have dollar price that is below par. So from a total return perspective, we still feel very positive that the US high yield asset class will continue on its strong trajectory that I think has surprised a lot of people. And now with a lot of that cash looking for a home, I think the US high yield asset class is well placed from a yield perspective relative to other asset classes to benefit from some of that move away from money markets. And I think the active US high yield ETF is a very efficient way to access the market at an attractive price point. So, hopefully this was informative and we look forward to seeing you once again.
It was a great webinar, Jack. At this point, I'd like to thank you once again for your expertise and the time you've dedicated to us today. I wish you a great day and of course all the best. I hope we'll see each other again soon. Und auch bei Ihnen, verehrte Zuschauer, bedanke ich mich recht herzlich für Ihre Teilnahme an diesem Webinar. Ich freue mich darauf, Sie in einem unserer nächsten Webinare der Swiss ETF Investor Days Reihe wieder begrüßen zu dürfen. Das nächste Seminar dazu findet bereits am 10. Oktober statt. Bis dahin wünsche ich Ihnen viel Erfolg mit Ihren zukünftigen Investments. Ciao und bis zum nächsten Mal hier bei Finanzen.ch.